How's everyone doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. So Blackrock keeps having another one of those one-off delinquencies. We keep this is one, two, three. You start to see four, five, six of these. That begins to form what we call a pattern. So we're going to jump into. So we're going to go through a series of articles here. I'm going to give you guys a little bit of an update on what's happening in private credit, what's happening with First Brands, some of these other companies that have been on the rocks here as of late. But this was another one that just came in. BlackRock sees 150 million Renovo loan as worthless amid bankruptcy filing. So BlackRock has written off its entire investment in Renovo Home Partners, a home improvement company that filed for bankruptcy amid concerns about the valuation of private debt. The drastic revision comes after BlackRock initially deemed the debt to be worth 100 cents on the dollar, but now estimates it to be worthless. The write-down highlights the disconnect between private credit valuations and the performance of underlying companies, which critics see as a major vulnerability in the market. Yes, I've been talking about this for over a year, and now these things are coming home to roost. But the interesting thing here is that this article, as you will probably see here, is coming from AInvest, a website here I'm not really super familiar with. But my question is, why is this not in the Wall Street Journal? Why is this not up on CNBC? You're not seeing like all of a sudden like these. This is one of the issues I've been pointing out to people with this is that these delinquencies have been reported under the radar. They're not being reported in the mainstream media. I am going to show you what is being reported, though. Now we're going to go to a number of Wall Street Journal articles. So First Brand, they sues the founder, accusing him of lavish spending at the company's expense. In the complaint, the bankrupt auto supplier claims that $500,000 was spent on a private chef. Not surprisingly. So one of the questions that has been hanging over the bankruptcy of First Brands: where did all the money go? So a lawsuit filed Monday by the auto parts supplier's new management team against founder Patrick James claims to have some answers. The lawsuit claims that $500,000 was spent on a private chef, $150,000 went toward a personal trainer, and $3 million was used to rent a New York townhouse. James enriched himself at the company's expense, diverting millions of dollars to pay for such luxuries, leaving just $12 million in cash when the company filed for bankruptcy in September, according to their suit. So now we go to the next article. So First Brand's founder regains access to personal bank accounts. A judge denied the bankrupt auto parts supplier's request to freeze its founder Patrick James' accounts. Kind of interesting. So First Brand's founder and former chief executive officer Patrick James regained access to his personal bank accounts after a bankruptcy judge on Wednesday denied the company's request to freeze his assets. The auto parts seller's new management has accused its former CEO, who stepped down after the company filed for bankruptcy in late September, of siphoning large sums of money from the company for his personal use. Judge Christopher Lopez in the U.S. Bankruptcy Court in Houston, who oversees First Brand's bankruptcy case, said there were red flags and how the company was handling its finances under James, but First Brands didn't show enough evidence, including that James personally directed anyone to make those transfers to support the extraordinary measures, Lopez said. So again, we'll have to keep an eye on this one and see how it plays out. Obviously, these are just the first steps to coming in here. I think Mr. Patrick James is going to have much bigger issues over the next couple of years in terms of how he defrauded his customers. But we'll see how that plays out. Now, BDO, the big accounting firm, BDO is First Brand's audit painted healthy picture months before its collapse. So again, as we've seen these patterns over time, Arthur Andersen with Enron. What are some of the other ones that I'm thinking of? KPMG with what was the name of that? Wirecard over in Germany. EY just got caught with something. I can't remember what that one was off the top of my head. But But now we got BDO was the primary auditor and accountant for First Brands. This is so the audit of the auto parts supplier didn't show the billions of dollars of off-balance sheet debt and unpaid balances owed to financing partners. So the auditor of beleaguered auto parts giant First Brands signed off on its financials this year, months before the emergence of an accounting scandal that sent the company into bankruptcy and triggered a criminal investigation. Documents that have emerged following First Brand's collapse show substantial discrepancies between the financial information that BDO USA validated and the financial picture that is now coming into focus. BDO's audit of First Brand's 2024 financials, reviewed by Wall Street Journal Pro Bankruptcy and CFO Journal, didn't reveal the billions of dollars of off-balance sheet debt and unpaid balances owed to financing providers that weighed on the company as it descended into Chapter 11. So, unfortunately, I think BDO is probably going to get dragged through the mud on this one. They probably have a lot to answer for here. U.S. insurers are binging on private credit, Moody's says. Now, remember, I just did an episode a few months back basically showing that Moody's was one of the companies that basically has called out the private credit industry and said, hey, we could have an issue here with this. But a handful of insurers are buying much of the investments, which are hard to trade and have relatively low credit rating. So illiquid investments constituted about 18% or $685 billion of U.S. life insurers' $3.8 trillion in fixed income holdings by 2024's end. The private credit boom is rapidly changing the investments made by U.S. life insurers, with some firms parking more than half the fixed income assets they need to fund policies and annuities and hard to trade debt, according to new research by Moody's Ratings. Illiquid investments account for $685 billion, about 18%. That's a huge number. Of the $3.8 trillion in fixed income investments insurers held at the end of 2024, the pace of purchases seems to be increasing, with less liquid private debt comprising about 23% of the $522 billion of bonds insurance companies bought in the first half of 2025, the report said. The industry's holdings are unusually concentrated, with just 10 insurers controlling about 43% of the illiquid assets held at the end of 2024, Moody's found. So, who are these insurers? Well, we got Security Benefit, Delaware Life, Mass Mutual, Alliance US, Global Atlantic, Thrivent, Corebridge, Resolution Life US, F&G, Athene US, and Industry Aggregate. So again, some big insurance companies here. You got to question the logic here. What are these companies doing? I mean, this seems kind of crazy. Private credit, which includes corporate loans, real estate debt, and complex asset-based securities, has surged as fund managers like Apollo Global Management and KKR replaced banks as the top lenders in some markets. The debt rarely trades, but that is less of an obstacle for insurance companies, which tend to buy and hold investments over the long term to balance their assets and liabilities. It also tends to yield more than publicly traded bonds and loans while helping investors to diversify their holdings. Still, during market stress, insurers may be forced to sell at unfathomable prices, leading to unrealized losses and earnings volatility. Yeah, you better believe it. Not only is the debt harder to trade, it generally comes from weaker borrowers, Moody's found. About 10% of the investments have junk credit ratings, compared with 5% of the overall fixed income investments insurers own. Of the illiquid investments with investment grade credit ratings, 41% had AA ratings, the lowest level above junk. That compares with 36% of overall investments. So again, big issue there with insurance companies. And then what else do we have here? Wall Street intensifies scrutiny of fraud after spate of loan losses. So lenders are increasing due diligence and demanding access to more data. So a string of alleged frauds by corporate borrowers is spurring a reckoning across Wall Street, sending bankers and investors scrambling to prevent future blowups. Lenders are increasing due diligence and demanding a longer history of financial data from companies. Some are inserting conditions that permit them to do more frequent checkups before agreeing to make loans. A group of the biggest names in banking, investment management, and accounting have formed a task force that will take a deeper look at the nature of the problem and how to protect investors. The frauds that have emerged so far, which involve small to mid-sized companies in sectors such as autos and telecommunications, haven't sparked widespread trouble in the market or the economy yet. but they have generated fallout for both regional banks and Wall Street giants such as JP Morgan Chase and Blackrock, and the string of revelations has made it harder to dismiss any one case as an isolated event. This is sending real ripples in the credit markets, said Colin Adams, partner at Izu and Lull, a restructuring advisor that works with both borrowers and financing providers. People are really starting to ask, how does this happen? It happens the way it always happens, with greed, with just pure greed on Wall Street, and people on Wall Street thinking that they're smarter than they actually are. And oh, hey, there's this private credit market over here. We could just dump all of our risky loans off of there. That gets it off our books. That means we got pristine credit quality now because we got rid of all the garbage, but not knowing that those loans eventually are going to go bad, or they're still going to go bad. They're still going to blow up. There's still going to be a problem. They're just trying to make it a problem for somebody else, but it's still going to come back to bite a lot of these banks and to bite the overall industry in the butt at the end of the day. But now they're starting to, take notice on this stuff. And like I said, we keep, there's another one of these one-off incidents that keeps happening. But the problem here is that this is too little too late. It's a $1.7 trillion private credit market. You have a boatload of bad loans. I can guarantee you there is a boatload of crap in there. And it's too late. You could go look at these companies, but the fraud is the fraud, and the bad loans are the bad loans. You're not gonna make them better by getting more financial information now. The horses are already out of the barn. Howard Marks highlights credit carelessness, but says issues are not systemic. Yeah, don't know about that. So the Oaktree Capital co-founder said the recent credit turmoil highlights the risk of complacency and carelessness in rising markets. Marks said defaults shouldn't come as a surprise, but doesn't think today's issues are systemic. The comments come after JP Morgan CEO Jamie Dimon warned of more cockroaches following the high-profile collapse of auto parts maker First Brands. So, I do think the problem could become systemic as it relates to the private credit market, not the overall market. Could this be systemic in the private credit market? Yes, I believe it will, and I will find that. Private credit earnings ease investor concerns over asset classes' health. Apollo's Mark Rowan addresses issues that have had investors on edge. Well, of course he is, because he's one of the biggest investors in this private credit. So he's doing everything he can to stomp down the roaring crowd as it's coming down the street going, yo, man, what did you invest in here? And then finally, here you go. Blackstone is offloading a flopped $1.8 billion investment in senior housing. Investment giant is selling off portfolio of about 90 properties, in some cases at over 70% below their purchase price. So real estate giant Blackstone is liquidating a major investment gone wrong, a $1.8 billion wager on senior housing that has saddled the firm with more than $600 million in losses. It is shaping up to be one of the New York firm's worst investments in recent years. Blackstone has been quietly selling off its portfolio of about 9,000 senior housing units across the U.S. through a series of one-off transactions, sometimes at losses of more than 70% compared with their purchase price, according to Wall Street Journal analysis of public records. Again, just another example of the stuff that you're seeing out there. So again, I do believe, to kind of wrap up, I do believe that this is going to continue to pick up steam. I'm going to continue to cover this and bring everybody updates on what is happening here with this private credit market and these continued company blowups. But again, another one this week with BlackRock seeing this $150 million completely write-off of this loan to Renovo Home Partners. So and then we had Blackstone writing off a $1.8 billion investment in senior housing, taking a $600 million loss. So again, crazy stuff happening out there on the horizon. But with that being said, I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you for listening. Have a great day out there, and I will see everyone again real soon. Thanks a lot.